Good morning, traders. My name's Aaron Hill, and welcome to another edition of Technical Talk. Today is the 10th of January, and time is now 8:41 a.m. GMT. Friday was an interesting one. December's payrolls out of the US. According to the Bureau of Labor Statistics, the US economy added 199,000 new payrolls, considerably less than economists' forecasts of 425,000 jobs. Despite a huge miss, the US unemployment rate dropped to 3.9% in December from 4.2% in in November. The consensus forecast was 4.1%. This is the lowest level since early 2019, and is important since this is considered by many to be full employment. In addition, average hourly earnings for the US showed wages rose 0.6%, beating expectations of 0.4%. This, of course, was followed by Wednesday's FOMC minutes, which carried a more hawkish than expected tone. The minutes indicated the bulk of FOMC members feel an accelerated pace of interest rate hikes may be in the offing sooner than expected, closely followed by a runoff of the Fed's balance sheet. FOMC participants also underlined the Omicron variant is unlikely to modify the economic recovery. Okay, markets. So Asia equities ended largely in the red overnight. Do bear in mind, Japan's Nikkei was closed in observance of Coming of Age Day. Early Europe, and we're seeing European equities largely lower. London's FTSE 100 is down 0.4%. Germany's DAX is down 0.5%, and France's CAC 40 is down 0.6%. And let me just quickly take a look at US equity index futures, which are also lower across the board right now, only marginally, bear in mind. So in terms of currencies right now, the majors, we are seeing losses in euro dollar at around 0.3%, mild gains in dollar yen. The Aussie dollar is currently unchanged, with the dollar Swiss now up by 0.2%. The Aussie dollar, in terms of the Aussie dollar, we are largely higher across the board right now, with notable gains seen in Aussie against the New Zealand dollar, up by 0.4%. Finally, we have a reasonably light calendar ahead for today, with limited high impacting releases. So on to the charts. We're looking at the short term for the Aussie dollar right now. We have seen some movement just as I was preparing for this. So on the Aussie dollar, we as you can see, we are coming off. This is the H1 chart. We are coming off supply at 71.95, 72.07. Now this supply benefits from the 72 psychological figure, as well as a 50% retracement. Now, do bear in mind, this is not a Fibonacci number, but it is a notable retracement to have on your charts. And as you can see, price has reacted directly off of that round number there. Also, something to keep in mind on the H4 time frame above is this area here between a trendline support turned resistance. This is taken from the low 69.93, which actually converges with a 61.8% Fibonacci retracement at 72.22. Now, if price tests this area here, assuming we jump above this supply here, this could be an area we see a reaction. Something else that's also worth noting is the Quasimodo support term resistance, again on H1 time frame. That comes in at 72.29. This converges with this area here. So we have some confluence around this area should we break above this H1 supply. Also, a technical note, we are currently testing the 50 center line, on the relative strength index on the H1 time frame. Now, moving over to the dollar yen, just quickly, as you can see, we are coming off the higher time frame resistances right now. This consists of a 1.272% Fibonacci projection on the weekly time frame at 116.09. And we are seeing some reaction off of this area, despite a clear uptrend current in play. And that was since the beginning of early 2020. Now, also in line with the 1.272% Fibonacci projection on the weekly time frame, we have daily Quasimodo resistance on the daily time frame at 116.33, which was tested early last week. Now, if we do continue lower, do keep an eye on the Quasimodo resistance turn support at 114.97 as a potential support longer term. Now, on to the H4 and H1 timeframes. For those of you who read the weekly technical report, we did highlight this as a potential support. And as you can see, we have bounced higher and also broken above the trend line resistance on the RSI. Now, this is the H1 timeframe, just to highlight this. Now, this was a support made up of the H4 support coming in at 115.38. This is the H4 timeframe, along with a Quasimodo resistance turn support on the H1 timeframe at 115.48, along with a collection of Fibonacci ratios, often termed Fibonacci cluster. As you can see, as I said, we have bounced higher, but we are seeing some downside as we speak. Ultimately, we were looking for the 116 handle and potentially higher, given the underlying trend right now, despite the resistances, of course. Okay, moving over to the excuse me, over to the dollar yen. So, although higher, in conjunction with higher time frame resistances. So when I talk about this, I'm referring to the higher time frame. So as you can see, we have a resistance area on the weekly time frame for the pound dollar. That's at 36.29, 34.56. Now, in conjunction with this, we also have trend line resistance on the daily time frame, along with horizontal resistance at 36.02, coupled with hidden bearish divergence coming out of the relative strength index on the again on the daily time frame. Now, what's technically interesting is the H4 and H1 time frames. Now, keeping in mind the higher time frame resistances, we have supply at, this is on the H4, we have supply at 36.65. 36.25. Now, in line with this, we also have a Quasimodo support term resistance at 36.27 on the H1 timeframe. Now, this sits just within the lower edge of the H4 supply. Below this, we also have the 136 figure. Most traders who have watched the charts for at least a few months will have noted that round numbers often are prone to whipsaws. Now, these are often referred to as stop runs. Now, should this occur at this point here, which given the higher time frame resistances in play, could be an ideal location for larger players to jump aboard, we could see a whipsaw above this round number into the H1 Quasimodo support term resistance, and then a subsequent dip back below the 136 handle. Now, conservative traders will probably place their stop loss orders above the H4 supply, which is a fairly large stop. But we could see some considerable downside from this point, technically speaking, given we have the higher time frame resistances also in play. Finally, over to the dollar index. Now, this was something we highlighted on not only our social media channels, but also in the latest US employment situation report for Friday. Just a quick overview of the higher time frame picture. We are in a uptrend. We have been since touching gloves with the support around 89.69 in May of 2021. And as of latest months, we have been forming it's unsure at the moment. I'm looking at a potential ascending triangle or a potential flag at this point, and that's bolstered by a support level at 90. 586. Now, should we break higher on the daily time frame, do keep an eye on Quasimodo resistance at 97.45 and the ascending triangle take profit target, which comes in around the 98.28 region. That's if we break out higher. Now, as I said in Friday's report, we did highlight this harmonic Gartley pattern, which, as you can see, was tested and did break out to the upside. Now, some traders, this is what many harmonic traders refer to as the PRZ. As you can see, we did clip below this area. This shouldn't be a concern for many, unless you had your stops below here, of course. But many harmonic traders will place their stop below the X point of the pattern. So you have X, A, B, C, D. Now, a harmonic Gartley pattern does generally come with a equivalent AB equals CD pattern, as you can see, and the defining point is a 78.6% Fibonacci retracement, along with a 1 point in this case, a 1.618%, just bear with me, a 1.618% Fibonacci extension. And also, let me just, I think it's a 1.618. I'll just enlarge the chart. Just give me a second. Excuse me, no, a 1.272% Fibonacci extension at 95.75, as well as now where's that coming in from? Sorry about this. A 1.618%. I'm just trying to think where that come from now. Just bear with me a minute. So we have the 78.6%, as I said, the defining level. Let's remove that so it's easier for me to. That's the Fibonacci extension, and this is the 1.618% is another excuse me, is another Fibonacci projection. This is not part of the harmonic Gartley formation. This is just an additional Fibonacci ratio. As you can see, it's taken from this point to this point to this point, so it's a Fibonacci projection, and that comes in at 95.76. And let me just bring that all together. And as you can see, we have bounced higher from here. So we are looking at a possible, let me just line up the take profits. Actually, we have hit the first, we have come very, very close. We have actually hit, I believe, the first take profit target, generally taken from the A to D leg for the harmonic pattern at around 96. And we have reacted to that. Should we continue higher, do keep an eye on the 61.8% Fibonacci retracement at around 96.18. Okay. So that's it from me this morning. Excuse my cough. As usual, any questions or comments, please email the research team at marketanalyst@fpmarkets.com. With that, have a wonderful week, and I'll catch you all again on Friday morning. Thank you.